Right. Good afternoon, good morning, and thank you for joining us today. My name is Xiaolin Chen. I'm head of international at KraneShares today. I have the great honor to joined by my colleague Brendan Ahern, who is our CIO at KraneShares. Today, we are very, very honored to have you join us on the call to go over what happened last year in 2023 in China and what is our outlook in 2024. It is a very topic market. I'd say there's more questions than answers. I hope in the following hour, Brendan and I would be great to share any market insights we may have on China and any questions you and your client may have on the market. We'd be very, very happy to address any questions you may have on the market. Just to quickly look back in 2023, we know the Magnificent Seven has proved to be very successful in 2023, but the uncertainties are mounting as 2024 just kick off. Just in the last couple of days, we have witnessed a lot of events happened in the market, in Asia market, in China market, in the US market, where the US dollar's rate is going to lead us this year, where risk assets will get impacted by the risk decision, where we're going to see the development by the Chinese regulator, policy in terms of monetary policy, fiscal policy, where are those going to land and how that's going to take, by the domestic economy positively, or will we see credits get picking up in 2024 that subsequently going to have a material impact to China's equity markets. In the following hour, Brendan and I will try to dive from all different angles to provide you as much as we can as a market insights. Hopefully, you find the session is helpful. We obviously want to answer any questions you may have during the webinar, and we hope you could use a Q&A at the presentation. I think if some of you are dialed in from Zoom, you have a Q&A button at the bottom of the app that you can send in your question. If not, please feel free to email us at info@KraneShares.com. That's info@KraneShares.com, while Brendan and I will address all the questions you may have. I believe this session also eligible for CPD, CAMA, and CFP designation, and you can receive an hour for continuing education credits by emailing us at ce@KraneShares.com. Right, let's get started. KraneShares, I hope many of you have joined us today would have known our firm. For those, for the benefits of those are new to our firm, we founded about 11, 12 years ago with a focus to provide clients a unique access to China capital markets, or a unique access to add it to your client's portfolio. Today, KraneShares, if we turn to the next page, we are very, very proud to have 3 pillars of focus on solution to help clients to access and address the investments needs and the opportunities in the portfolios in 3 pillars. One, and first of all, most important, China. As the largest, second largest economy in the world, its capital markets of equity markets and fixed income markets are also the second largest economy, second largest in size. Its representation in global indices is really at the low single digits range. We firmly believe this is under-allocated, under-owned market to clients' portfolio. So at KraneShares, we're very proud to have built a series of tools and toolkits allowing clients to allocate in a core allocation, satellite allocation, thematic allocations to access to China. Our second pillar is in the green category, and namely anything can help with the climate change, green transitioning, energy transitioning. We express those solutions in carbon markets, in equity markets. We have global energy, clean technology, clean energy funds. We also have a global electrical vehicle ecosystem funds, etc., to allow clients to access. Obviously, the last but not the least is uncorrelated or alternative investments that touch in equity in fixed income, in CTA space as well. These all solutions are available on this page are ETFs in the United States listed. On the next page are the funds that we have similar strategies like in the United States, but now is available in the UCITS solutions. These are the 8 funds we are made it available in UCITS ETF. As such, they available in local currencies, euro, dollar, and sterling, listed on various stock exchange to allow clients to access more conveniently. Let's go to the next page to take a quick look of how the market has returned in 2023. I touched base this on very briefly. Clearly, United States has led the majority returns when you compare to other global indices that's directly contributed MSCI All Country World Indices in 2023 to finish in the 22.8, a positive close to 23% returns. That's majority contributed. If you see a breakdown by NASDAQ, namely all the tech name, we mentioned the Magnificent Seven that is categorized under. That being said, because of the macro factor, because of the investment sentiments, also because of China was the first year out of the pandemic restrictions that is on its own trajectory to recover its economy. Broadly speaking, Chinese equities has underperformed broader indices. We'd like to look back and learn what drive the market returns, what caused the differences, what has we learned from 2023 as a lesson, and most importantly, what can we look forward to in 2024? How and where do we still see opportunities under all these noises and all these macro-driven performance returns in Chinese equities? Is this sustainable? When is the market going to return to fundamental-driven to allow the equity market to return on its own foot based on the fundamental earnings these corporates in China is actually returning in the last quarter and last year. So in the following sessions, Brent and I will share different sessions to go through each of different catalysts. But like I said, please feel free to send in any questions. Brendan, at this juncture, I'd like to pass it to you to share some thoughts or say something greetings to our clients.
Yeah, 100%, Xiaolin. And one of our core thesis that historically we've spoken to investor that's articulated in our 2024 Outlook piece, which is now available on KraneShares.com, has been this significant outperformance of U.S. equities versus not just China and emerging markets, but really non-U.S. equities that since the global financial crisis low through today or through yesterday's close, the S&P 500 is up 835%. And yet Chinese equities, as defined by the MSCI China, are barely over 100%. But this underperformance is not driven just as not unique to China. MSCI emerging markets is not even up 200%. And in fact, all country world ex-US, so all stocks minus U.S. stocks, is not even up 1/3 of U.S. stocks. And it's interesting that we see an element of investor trepidation around China, and you've actually seen the growth of EM ex-China strategies. But in fact, MSCI emerging markets Latin America has performed almost as poorly as not just China, but emerging markets and non-U.S. stocks. And yet you don't hear about EMX Latin America strategies, do you? And I think the culmination of 14 years, 56 quarters of client calls, board meetings, trustee meetings is investors are grossly underweight non-U.S. EM and China. And the most crowded trade globally is U.S. stocks. And again, on KraneShares.com, we articulate this thesis in our 2024 Outlook. And the last gasp of this U.S. equity outperformance has been under the narrative of AI investing. We see this renewed Magnificent Seven U.S. tech equity outperformance at the expense of basically all other stocks globally. And we just don't see how this is sustainable, particularly looking back over the last 14 years, and a contributor to this outperformance on the next slide is that in order to keep up, active managers, global equities, have moved so many of their assets into these top 7 stocks that, utilizing our friend Stephen Holden of Copley Fund Research, he's proven this by looking at the underlying positions of these actively managed funds. In order to survive, these managers are buying these small subset of securities across the thousands of securities across the globe. They're all piled in overweight in this small subset of securities. And from our travels of engaging with many investors across the globe that utilize our exchange traded funds, we just cannot remarkably find how many of them are overweight U.S. equities. But some element of that is out of self-preservation, that there's only one asset class, one subset of an asset class that's working, and that's this small number of U.S. tech plays. And I think on the next slide, if we step back, that unfortunately as we age, we can say that reminds me of something. And I can't help not remember in 1999, we had a very, very similar situation where a very small subset of, again, U.S. tech stocks were the only thing that was working globally. And investors all piled into these names at what turned out to actually be at the exact worst time. And in fact, if you look at what happened following that small subset of securities, it turned out it was that concentration that of this small number of stocks representing such a disproportionate percentage turned out to be the proverbial canary in the coal mine. And I think we've seen this. The financial sector became 25% of the S&P 500 right before the financial crisis. And we're seeing that situation again play out. But we have to understand that why is all of this money coming out of non-US, out of EM, out of China, into this small subset of US? It's an AI craze, or is it just the survivorship, the necessity to own the only thing that's working? And another factor at play on the next slide has been the shift from active to passive. That active managers in the EM space, but certainly for global equities, are losing their assets to passive index funds and exchange traded funds. And data from Morningstar shows that it's kind of remarkable. 20 years ago, 90% of EM assets were actively managed, but that's dropped to 60%. Now, in fact, active fund managers are managing the exact same amount of money as they were 10 years ago. Now, why is that important? It means there's less managers around that exist to buy the dip. And in fact, one of the things we've seen is that many of these active EM managers are actually buying U.S. stocks. One of the developing market funds here in the U.S., their largest holding is Microsoft. Does that make any sense? But if you think about this long period of non-U.S. equity outperformance, the only way they can survive is buying the only thing that's working is U.S. stocks. And this is happening from professional managers all over the world. They're all going into the most crowded trade. And I think, again, going back to having seen this before, on the next slide, if we think about some of the headlines we're seeing today on investing in China, it reminds me of what I was reading back in March of 2009. When the U.S. market hit rock bottom, U.S. and many global investors gave up on U.S. stocks. And that turned out to be the best time to buy. And the similarity of these headlines when you talk about China and market sentiment versus back in when it came to U.S. stocks. Then, and I understand a little bit of why the sentiment exists on the next slide. That back in 2009, you had a 10-year period where U.S. stocks had a negative return. I mean, if you invested in U.S. stocks from 1999 to 2009, it's not only that you lost money for those 10 years, it's you suffered 250% drawdowns. I mean, who can take that? And what do? You give up. You simply give up. You capitulate. And I think that same scenario can be applied today, that we have 14 years U.S. stocks have outperformed non-U.S. stocks, including Chinese stocks. And the end reality was this capitulation built the foundation for the U.S. bull market, equity bull market. And I think the capitulation, when you talk about China, has actually built the foundation for the next 10 years. And that's true for China, emerging markets, non-U.S. equities. And I think the extreme situation of what's exacerbated this capitulation has been what's been taking place in Hong Kong more recently. That on the next slide, there are it's called Callable Bull Bear Contracts, CBBCs. And these are contracts issued, investors buy these contracts that give them exposure to Hong Kong and Chinese indices in Asia, particularly Hong Kong. And unlike European or US structured products, these contracts have very explicit liquidation levels, knockout levels, if an index or a stock in Hong Kong or in China hits those levels. In China, they call these contracts snowballs. Mm-hmm. And what you can see is, this is using the Hang Seng index as an example, is that over the last month, as the markets come down, and again, you have this absence of buyers, that investors, they only own one thing. You have these U.S. tech stocks. So this absence of buyers has exacerbated a situation that when these contracts hit big round numbers in the Hang Seng index, like 17,000, the issuers have to liquidate the underlying. So in this case, they're liquidating Hang Seng index futures. And there's the lack of buyers because of this infatuation with U.S. tech means that the market takes an elevator down. And then what you can see, what happened when the Hang Seng hit 1650, 16,000, right? Elevator down. There's no buyers because they're all in U.S. stocks. Now some of this is a trepidation of investors not wanting to try to catch a falling knife. They're worried about some of the China headlines, but it explains this dramatic underperformance. And people say, it's because China's GDP numbers. I mean, the China numbers beat the expectations. It's just investors have been sidelined. And that's led to this dramatic downdraft. Now, I think one of the things we want to talk about is why investors should want to come back. What are the catalysts for investors to say, hey, enough is enough. We got to get back in. And I think, today it's noted that NASDAQ's price to book is higher than Hong Kong's PE ratio. I mean, does that make any sense? The only explanation is this most crowded trade U.S. tech stocks globally. And we think that there's some reasons that investors should be coming back in, taking a look at what's happening, particularly in non-U.S. EM, but particularly in China. I know on the next slide, Xiaolin, we're noticing one of these things that investors should be getting on their radar.
I agree, Brendan. I think with everything you said, trying to explain what was causing the kind of like corrections in the recent days. One of them was now the expectation to say US dollar, the rates may stay high for longer. And we see in one of your CLN, I think it was yesterday, you mentioned US 10-year Treasury now has surged past the 4% level again. I haven't checked today, so I apologize if it's back down, but it was 4% yesterday when we're looking at it. So that really also weighted heavily on, per se, risky assets, and obviously created a bit of a discussions to say where and how we're going to make the dollar, strengthen. We go back to dollar assets, put on a lot of pressure on obviously risk assets, causing some, corrections. But one of the correlation we have been studying and noticed is the correlation between KWEB and CNY. Which is as a very clear indication of the renminbi, picking up. And on this chart, you can clearly see that we go back as far as when the fund was since launch. So this is over 10 years of data. Obviously, we have studied and learned that now by looking at it, KWEB is highly correlated, or the relationship of the correlation are positively developed since 2017. Obviously, at this juncture of time that we have studied the trends, we'd like to think that, renminbi's, given where renminbi is at today, that's given the activity picking up in China, given all these policies that is set, given all this liquidity is in the system, so we do expect manufacturing and subsequently all the other activities to pick up, hence supporting our view on the currency would actually go positive from here. Hopefully that is a steady, a catalyst we could look to say, if that's the case, KWEB as a result should actually have a one as positive catalyst to pick up from here, Brendan.
Yeah, I think, Xiaolin, it's such a great point that, the last decade's been marked by, the U.S. Federal Reserve cutting interest rates. And, certainly, we're in a very different environment, and the dollar, the U.S. dollar index since the 2011 low is up 40%. If U.S. stocks over the last decade kind of robbed the bank, the U.S. dollar is driving the getaway car, right? The U.S. dollar has aided and abetted this outperformance of U.S. stocks, and it'll be very interesting, right, to see what Fed, we know Fed policy is going to evolve this year. There's a big debate on interest rate, but I think we start seeing those interest rate cuts. There's a strong argument potentially for the dollar to weaken a little bit, and that might help in this movement back to non-U.S. China, and particularly China across EM. Certainly on the next slide, one of the other indicators we've noticed is that asset classes always compete with one another. Where am I going to get my best return? And one of the way to think about that is putting yourself in the shoes of an investor. So in the case of U.S. investors, we know you can get a lot of money just sitting in a money market fund, or up until last year, I never bought a certificate deposit, and now I'm like an expert because I'm getting like 5.5%, and that money would have gone into stocks. And so if you think about what is a money market, how does a money market compete with stocks in the U.S.? Well, we could look at the dividend yield. This is very simplistic, and you'd say, U.S. stocks look very unattractive relative to what cash gives you. In the case of China, it's the exact opposite. That if we look at the dividend yields of mainland Chinese stocks versus their 10-year treasury, stocks have never looked more attractive. In fact, stocks in China yield almost as much as the 10-year treasury. And that's a situation that's never occurred in China. And in this business, you never say never, but we're saying it today that Chinese stocks have never been cheap as this inexpensive relative to bonds based on this very simplistic measure. And I think if you continue to see easing, incremental policy easing in China, it's only going to exacerbate that trend. And I know, Xiaolin, we know some of the things that weighed on investing in China, things like the zero COVID. But I know, we want to talk a little bit like some of the fundamentals of these underlying companies how are they looking to that?
Brandon, it's fairly to say when we, trying to get the real insights from it. And at the beginning, we did mention, we think the current performance is completely disconnected with fundamentals. We have evidence to say so. It's not just looking at it. If you count it, it's all the policies announced last year, monetary, physical, corporate policies is all on pro-growth, where the market is taking every opportunity to say, where can I find a bit of a slightly negative angle? Let's sell. The reason we say that is if you look at this page, is this purple bar is showing the top 10 holdings in the KWEB fund. What are the quarter-over-quarter of earnings throughout its history? This blue line shows KWEB's return. And if you go back to history from 2019 or even earlier days, clearly the fund performance in reactions or in reflections of how the underlying company has been performing, which is very fair. How you performed, we return stock performing in conjunction, in line with that. Obviously, since pandemic, the market start to behave very differently. It started taking a lot of macro headline news to react on performance. And since then, you see, obviously, because of regulations impacted the sector, because of the COVID impacted the industry and economy as a whole, we did see a bit of a correction in earnings, but then the corporates really very much back on their own foot to continue to return quite interesting, quite attractively in terms of revenues quarter over quarter, where the fund's performance is completely on a different direction now. If you see the blue line, it's continued to going down. But obviously, we have seen picking up in performance marginally in reflecting the solid fundamentals quarter over quarter the fund has been generating. All that being said, we do think that at a certain period of time, macro factor could drive on the performance, but cannot be sustainable or cannot be long-term of drivers of stocks performance. In this instance, we do think that the fundamentals will drive the stocks performance this year, given all the set scene of the macro level are very pro-growth. That will give investors the confidence that it is the time to look at the fundamentals. It is time to reflect the strong growth that each company has been producing, and that would reflect the gap between the current performance and the quarter-over-quarter earning accumulated by all these companies, the big gap. We do believe that gap will have to close.
Yeah, it's just remarkable that you'd think these companies have been put out of business, and it's the furthest thing from the truth. But I think going back to this thesis of this U.S. equity outperformance over 14 years, just pulling all of this money out of non-U.S., out of EM and China, going into U.S. mega cap tech, has created a situation that's reached a level of ridiculousness. Regardless of what AI does or doesn't change our world, the simple reality is that with the market cap of Amazon, you can buy all 31 companies we hold in KWEB and have almost 400 billion in cash left over. I mean, if you think about that, saying Amazon is more important, has the same purchasing power of 1.4 billion people. I mean, just yesterday, retail sales, it was reported the online retail sales is growing pretty dramatically. I mean, you're telling me one company is more important, but to explain, all of this money coming out of non-US stocks, it's creating this level of ridiculousness. And remember, if you aggregate the 31 companies in KWEB and compare that to Amazon's revenue, Amazon's cash flow, Amazon's net income, Amazon earning per share. Amazon is lower on all of them, all of them. And it just shows this forced capitulation, we feel has really created a compelling buying opportunity in China today. And it's self-serving and highly biased to say, okay, well, but we're going to say it, right? And one of the ways to prove this thesis is there is an investor who actually breaks out, a Hewlett-Packard 12C calculator, actually does the math, and that's bond investors. So what has Alibaba's bonds, which are denominated in US dollars? So if we look at this, you have to recognize that just like any bond in the US, as the US raises interest rates, bonds have duration, they go down, right? So Alibaba's bonds have come down, no different than other US corporate bonds or US bonds in general. But how is it possible that Alibaba's bonds have outperformed its stock? Why are equity investors, because they're driven by sentiment, bond investors say, is a company generating enough cash flow to pay back the coupon payments and principal of its bonds? And just to be aware, Alibaba has very, very little debt, very little. And this is true for Tencent. It's true for Meituan. If you look at their US dollar bonds, same thing is true. The bonds are outperforming. It shows, it is evidence of this capitulation. And it's why we think investors should be coming in. Now I know one of the things, Xiaolin, that's really weighed on investors has been the US-China geopolitical. I think it's worth highlighting some of the things, we've noticed as a team on an improving situation there.
I'd agree. I think, from last year, we have seen many interactions, let's put it that way, to start at that high level of senior leadership interactions. And then that's really let Xi and Biden meet again later in the year. I think a lot of efforts been put in either by Janet Yellen, all these, very much key figures in deciding in the US relationship with China and vice versa. China also represents to Davos, so everywhere, to make sure they connect, they talk, and they make sure the environments, or at least the overall sentiments towards each other is very pro-growth, very pro-constructive. So they finally met each other later the year, Xi and Biden in November last year to meet in San Francisco. One way or the other, we see positive progress. Let's put it that way. We obviously see number one, number two economy in the whole world. Literally anyone just want them to be talking to each other, to have a conversation, to have a discussion, to have a dialogue, and literally to be able to be moving on, even disagreements in a constructive way. They did that. I think that box is checked. And the fact that President Xi Jinping flied thousands of miles away from Beijing and willing to make that trip to United States, that shows a lot of one, US is an important partner to China. Second, from China's side, they clearly wanted to be working with United States more constructively. They show their commitment. And then third, I think he also hosted a dinner in San Francisco, which I think John had the pleasure, attended the dinner, and he listened to Xi Jinping's speech by himself, okay? No translation, no whatsoever of second, third take of how they take on Xi's speech. And John was there among all the CEOs who listened to his speech. It was very much, we open the door, we welcome international investment to our country. Can we believe that? I would say yes. He has no reasons and rationales to fly thousands of miles away to the United States to please USA CEOs, okay, unless he really mean it. And he did it when he come back. Remember, I think he approved MasterCard to do business in China. Credit cards business is very strictly only dominated by the 4 big banks in China. Opening up a credit card business for MasterCard is actually a very big step forward. in terms of a financial reform welcoming or set an example of they want to welcome foreign investments into China. I mean, many to come. I think there's other announcements came after the visit, so on and so forth. So to me, this is a very interesting year, biggest election year in the history, probably UK, US, many are under election. So we got to watch and see. But then the intention from China's side couldn't be more clear. They want to work together. So I would say that. And then on top of that, if you look at the economic data, obviously it's very hard when you have a bit of a top level that is talking very tough with each other. But at the end of the day, if you look through the noises on the next page, we literally had this trade data. Our analysts put this together. I think it's very amazing to see, despite all the high level discussions and talks happening all there, China is still remain the largest and the #1 trading partner with the United States. With proof, you can see that when China welcoming US business into China, when they continue to make sure approving new business that is used to be quite restricted in China on the restricted list, now it's become more open. We expect this trend actually continue to happen, continue to be the way it is. So business is doing business continuously. The business in China or in US continue to say, we got to put our shareholders' interests first to make sure we continue to trade with the largest trading partner that we have and continue to generate revenues that we can for our shareholders. This is very encouraging to see, even despite all the challenges we have seen and witnessed in 2022, I believe is the same trends. In 2023 is the same trend. So it's very encouraging to see that. The other topic, I think President Xi went to San Francisco to see Mr. Biden was also for the reasons of Taiwan. Obviously, the election happened just about I think it was 16th of January when the results comes out. It was one of the weekend that the results comes out. The current party win the election. Obviously, they were talking very soft during the campaign time. Now they win the election. Is now they say they will put the people's interest first. I hope both sides, the leader keep their promises. If they put that people's interest first, that would have to mean they have to create a very friendly environment on both sides to allow business to continue to work with each other. At the peak of when China entered WTO, we almost had every Taiwan business that had a revenue or had interaction connection that is in mainland China. So you see the peak was to go back to as close economically tied as that. Brandon, you were in Asia. Was there anything you want to add on China and Taiwan?
Well, I think one, a lot of investors say we're worried. I think it's one of the things we write about in our 2024 outlook is again available on KraneShares.com. Is our brains look to find easy solutions to sometimes complex problems, and I find this topic is a complex one. Taiwan was part of China until the Japanese invaded in 1900, following the Opium Wars, in the events that led to World War II. But you never read about that situation. And I think, ultimately the movement of the Biden administration to stabilize the relationship is because, the world can't afford, the U.S. and China. In fact, both sides have so much, we're interdependent upon one another, and that negates, I think, this easy, simplistic narrative of China rolling in. And that's why we love showing people that part of Taiwan sits just 3 miles off the coast of China. And, again, we're very dismissive that, the world, China, the U.S., there's so much to lose. There's no upside on this issue. And yet it's such an easy to say Ukraine, Russia, China, Taiwan. And I think you have to realize, you have to do some of the math that the effects is just too great for the two largest superpowers not to get along with one another, especially considering how intertwined our economies, our stocks are. I mean, people say, I'm worried about Taiwan, I'm gonna get out of my China stocks. I'm like, let me help you get out. Get rid of your Apple, your Tesla, your Exxon Mobil, your Starbucks, your Nike, your Boeings. U.S. companies are doing great business in China. I think that's part of the Biden administration looking to stabilize the relationship. At the same time, Xiaolin, I know things looking forward for China's economy. It's kind of remarkable to think that, China's doing twice the GDP of the United States, and yet all the headlines I see are, how bad China's doing. Like, it's doing twice as good as the U.S., and yet you don't read any headlines, right?
I agree. I think, I think you and I often get into the situation. I remember when Alibaba released their earnings last quarter, domestically, obviously, they matured, so single digits return, which meet expectation, and internationally, 53% year-over-year quarter, revenue growth. I was pretty gung-ho about it, and market pick, Jack Ma, the guy who founded it, but has disconnected from daily management for 4 or 5 years by now. That he wants to do some investment from his own family offices. He wants to sell some stocks, and the market don't correct it. So I think sometimes we have high expectations, but we also get to be realistic that some data is released in China actually shows the results that the whole economy is recovering, is doing well, is on its own trajectory. And what is worth noting, like you were saying, the GDP numbers in China on this page shows that estimations is they're going to deliver 5% year over year from here, which they did this year for 5.2%. If you look at the next page, what we put together is just to remind the people that this is really the first year for the country to just get out of the restricted pandemic. It's the first year they return to focus on growing its economy. It's probably take them about a quarter to realize that, we have to provide sufficient liquidity into the systems. That's why from March last year until the year end, you have seen nonstop, continuously support by the policymaker in China. I literally lost count how many times PBOC has cut the rates to make sure liquidity is sufficient for the corporates to borrow, the credit is available, the rates on mortgages, first down payment, all of that get reduced to help the household in terms of they have more money to spend. If the mortgage go down, if you have more income to spend, so on and so forth. From all these 9 months, you have nothing, but every policy meeting comes out with one key message: it's pro-growth. If you ask me last year, the results from all the meetings in terms of monetary, physical, corporate policy making is all pro-growth. I think this foundations or the fundamental, the solid fundamentals has been laid out such strong way for the economy, for the corporate to be able to take up from here, to take the liquidity to rebound from here. Obviously, that's last year, but I like to draw people's attention to say, you know what, overall, China's focus, if you look at the next page, this is where China is focusing on growing. Obviously, we want to know, like a lot of clients ask us, where do I look at the growth? Where do I know where China is focusing on its own growth? It's finding the job or it's creating the job to feed the people. They want the stability of the social stability to make sure that people has a job, has a better future to look up to, have a very wealthy future to look up to be able to help their own family, their own standards and own status, and also at the long term, China be able to make impact on international status. And we didn't touch base them on today. We didn't have all the time we needed or we wanted. Is on the green transaction side. China invests 500 billions every single year to deal with its climate issues. That's why they are the largest solar panel producer. Nothing but that. They focus on the investment. They focus on their own developments. They are the #1 waste process technology in the world. And we're like, waste process, yes, they're #1 in those green transition technologies to make sure they are the leaders in those space. We should work with them. We should take advantage of where the investment opportunity is. Let's really take advantage of those that is present in our solutions and portfolios if possible. What we also did is obviously, Brendan, you and I holistically get asked often on this is, what are the catalysts? What do we see, has happened last year? Where can we look forward to? I'd love you to jump in on this as well. But my most proud on this page is bottom right-hand corner. This is a classic example. People say, China is people is not spending, the consumer is pulling back, is sit back, they're not spending. I didn't see them on the street, they didn't come out to spend massively. Of course, they got to look what is suit them to their lifestyle, their style of spending per se, their style of per se holidays or treatments for themselves to reward them to work hard for the whole year. This is in the city called Harbin. It's literally my hometown. Harbin had a very famous international ice sculpture for 24 years. And this year they built probably about the largest possible ice sculpture this year. And this year, Harbin suddenly become the place to go. I'm very proud for the city's achievements. Literally in just 3 days, national holiday of 1st January in China, just in 3 days' time, the city welcomed 3 million people in 3 days and generated 6 billion revenue just in that 3 days of time. Now people is loving the destination, love the place to be, to travel as a holiday destination. Now the city expects they will welcome 300 million people domestically in China to the place, and then they will expect billions, if not trillions of revenue as such. So it's people spending, of course they're spending, this has become very selective where to spend, how to spend. If people are not spending, I totally disagree. Look at the numbers and revenues. Obviously, when you look, go ahead, Brendan.
I was just saying today, Richemont, the Swiss luxury watchmaker, reported that their Q4 China revenue was up 25% year over year. Some of the data on bookings for Chinese New Year coming up in a few weeks looks really, really strong. Yeah, it's one of the things that when I was in both Hong Kong and Shenzhen last month, restaurants were crowded and malls were crowded, and when I went to Shenzhen, it was there were headlines, new COVID crisis in China, and I got to Shenzhen, they were running the marathon that day. I mean, it just this disparity between the call them the nadering nabobs and negativity of Western media versus the reality of what's taking place, what some of the data is telling us. It's
I think, we touch base on this, we see actively stock buying back, like Alibaba. I can't remember such a growthier company that's now announcing issuing dividends. We look at their current ratio, cash ratio, absolutely most liquid. They are very low leverage. They have pile of cash. Now they have decided to buy stock back, and they also announced first, I think in 20 years, if I get the time right, of issuing dividends to their companies. And this is all showing that now they say, you know what, this is absolutely the cushion. If not, we're buying our own company back. And obviously, from the government perspective, we see nothing but very pro-growth and supportive policies. I know now, we have couple of rounds of trillions of renminbi injections by the government. First, they announced 1 trillion bond issuance to help infrastructure, green infrastructure. Then the PBOC announced another 1 trillion to give to the property sector. And then very recently this year, into this new year, we got another new 1 trillion debt issuance that will happen this year to also help the needed industry. I think the liquidity is very rich, is sufficient in the systems. The policy is in place. I do think, if anything, you call a near term would be, the MPC happening in March, Brendan. I'd say we would have some more concrete policies announced that will touch base on sectors such as how they're going to boost the consumption again, or even more stronger, how they will allow all these splits of individually going to IPO to continue to happen, how they're going to reform their financial markets. I think all of that would be fundamentally in any market, that would be a huge positive. I hope that investors are fairly treating China as a capital market with all these positive news together as a key catalyst to consider in 2024.
Yeah, I couldn't agree more. I mean, Meituan did their first stock buyback program since going public in 2018, just last week. Today was the 7th day of buying. Tencent buys back stock every single day. I mean, it's something that, yeah, we think it's very heartening that the companies themselves believe their stock is so inexpensive. And we just, again, it goes back to, it's not about the fundamentals. It's just everyone overweight these same U.S. tech names. And, I think that's really our core view is that, we see such an opportunity today. And both on the next slide, we should kind of show some of the, in thinking about, one of the ways we think about China is offshore China, Hong Kong, the US ADRs are predominantly how foreign investors think about China, whereas the onshore Shanghai Shenzhen market is more indicative of what do Chinese investors think about China. And and I think those two markets can really move quite differently. Very low correlation between the two, and we think there's a strong rationale for both of these markets to come back in 2024. That we just think on the offshore China, on the kind of the K-Web market, it's the valuations. We've reached this level of ridiculousness. The companies are buying back. These companies have not gone out of business, as well as the situation's really been exacerbated by what's happening with this callable bull bear contract liquidation taking place. Similar factor at play in mainland China. Mainland China, they call these contracts snowballs. And many of those snowballs have hit these liquidation levels. In the mainland, we've seen explicit intervention in the market that, today, like yesterday and the day before, you had entities, the proverbial national team, buying mainland equity ETFs in mainland China. And the government is literally saying that we think this has gone too far. And so we see policy hopefully raising consumer consumption. At the same time, the one area that we recognize is that how do we know we should be buying, as professionals, we know this opportunity. How do we do it? And I think that's where the answer is carefully. That I think, we have to volatility or adjust our position. We don't want to buy so much that if we have a drawdown and we're not forced out. So we can dollar cost average. We can take the number we're thinking about, divide it by 4, by 5, spread it out over months, over a year. There's ways that you can use options to protect yourself. It's called, write a call to buy a put. So for potential, K-Web in the U.S. very, very high option open interest. That's led to us listing Clip, which owns K-Web and writes a call off it. Hopefully, we can get that up and running in Europe in no time. Allow one to get the exposure to say K-Web. So we're huge believers. I think we know that it's a good time. What we're not is market timers. And so, how do we come off the sideline to take advantage of this opportunity? That many of these headwinds have become tailwinds, or the headwinds have come down. And we see this great opportunity. That's ultimately why, what the KraneShares team in Europe and the US, globally is about, is helping investors understand how do we get this exposure, but do it in a way that is aligned with our risk parameters, our volatility adjustment. And I know got some compliance slides, and then we can dive into some of the questions I know have been coming in over the course of the presentation. And so certainly, yeah, please, we've got the chat button, or you can use info@KraneShares.com to send any questions. I think in general, yeah, we're seeing a lot of questions, Xiaolin, just about what are the catalysts to get this market going again? And I think fundamentals are always important. That in the long run, the stock market is a weighing machine, not a voting machine. But I think you're actually, we're seeing, this capitulation in Hong Kong around these bull bear contracts, is, to me, it is an indication of a potential, hopefully the bottom, just because the valuations, and I think at some point, investors have to recognize this huge overweight globally, the U.S. stocks, particularly the U.S. tech plays, against the backdrop of a potential falling dollar, potential budget issues, that we continue to kick the can here in the U.S. on addressing the issue, which has led to 34 trillion of government debt. There's a point at which investors should care about these things, and I just think simply we've reached a point where we have been engaging a lot of investors. A lot of investors are coming to us saying, "This is just too cheap. How do we do it? We know we should be doing it. It's just more of how do we do it in a way where we can protect ourselves?" And that's where I think the dollar cost averaging, option strategies, structured products are a way to get that exposure on, but protect ourselves just in case. Any other questions kind of popping out to you, Xiaolin?
I think there's a question of saying now we see the stocks, underlying stocks in our fund start to buy back. This is a question from Grant asking if that continues, will some of the company become privatized? It's a very valid question.
Yeah, I mean, it's interesting, we lost a smaller holding, was taken private, China Data, actually taken private by a U.S. private equity firm. And I think, it just shows, because so many of these companies they have no debt, they have more cash than debt. We're seeing the companies like, I mentioned that, we talked about Alibaba, Tencent, Meituan, historic Baidu, Tencent, buying back stock, and it shows that they're believers. We don't envision one of the bigger players taking themselves private. Certainly across some of the smaller names, it's something we have seen. And again, that's something we saw back in 2015 when the mainland market reached bottom. It was when a lot of these companies took themselves private, and we're seeing that again, more smaller names. It's the capital intensity of some of these bigger companies be really, really hard. And if anything, you're going to see more of these IPOs coming. If it's Shein, Temu, Lazada, we definitely see that coming for sure.
Right. Agree. And Andrea asked the China versus the Japan style lost decade. Andrea, would you mind, if you're listening, you get in touch with us at info@KraneShares.com, because we did a deep analysis of a table side by side to compare each of the categories that you would seen happened in Japan between the periods you mentioned between 1980s to 1990s, of the key items of GDP, population, real estate, corporate policies, the projection of growth, so on and so forth. We did a side-by-side comparisons ourselves, very detailed one. We'd be very happy to share with you on that analysis. So please do get in touch with us. We'll be very happy to share that with you. Brendan and I will share that with you, Andrea. And just at a high level, I think the comparison, at least the analysis we done, Brandon, if you recall, was China is obviously in the demographic front stay a bit similar to now become of a less new baby bond. But on the high level, China has still have so much they can do. Okay, the corporate policies, the government supports, monetary policies, the growth trajectory are very different. The demographic in terms of urbanization of the society in China versus Japan are very different. China is somewhere around 60, aim to achieve 90. That 20-30% would still lead another 300-400 million people to continue to move to cities. So long story short, we don't agree with that statement, but we have done a very thorough analysis of each the subcategory.
Yeah, and I think the the demographic question we see often, and Japan went peak population in 2013. Has that affected its stock market the last few years? South Korea has the worst demographics of any country in the OECD. And yet, Samsung's stock was been one of the best performers over the last 20 years. So demographics are a long run issue, but particularly for countries like China, Japan, South Korea, that a large segment of the economy is export driven. It's more about the demographics of their customers as opposed to internal demographics. So, it's in the case of China, if you take the current birth rate and stretch it out over 100 years, China's half its size. But there's someone that knows that, and that's the Chinese government. And we're seeing, beta tests in various cities to try to incentivize couples to have more children. And I think China, the Chinese government has a great track record of preventing crises before they get out of control. And I think that's something that is very much on their radar. And we've not seen the definitive solution, but it's coming.
Agree. And I think David asked us why we showed the top 10 holdings fundamentals to the price to KVAP. I think that was the page I gone through, fundamentals, not of all the holdings. The top 10, David, would give us, if I'm not mistaken, 60 to 65% of the overall portfolios. If we include all the names, David, the picture are similar. We'll take your point. Maybe we do analysis of all holdings, but David, the top 10 literally give us the majority of the holdings of the fund anyway. But if we the whole fund, it's probably similar.
Yeah, it's a good question. It's we're not cherry picking the data to paint some rosary picture. It's some is just the simple reality of our colleague Henry that due to acquisitions, IPOs, again, mergers, acquisitions, there is movement, turnover within the portfolio, and it gets very complex very quickly if you go back over 10 and a half years of on a quarterly basis adjusted. It's much easier to stick with the top 10.
I think one asking, does the US still have regulators in China? Maybe that's related to the ADR question. I think if you are asking, and you're asking if the US SEC send the regulators to China to do the auditing to meet ADR listing requirement. Maybe any updates on ADR front, Brendan?
Yeah. The based on the Holding Foreign Companies Accountable Act passed by Congress, that said that U.S. listed China ADRs would be delisted if they didn't allow the Public Company Accounting Oversight Board, the PPOC, to do reviews of the auditors. They could be delisted. And in August of 2 years ago, 2022, the Chinese government changed its law that prevented that. And in September of 2022, the PCAOB went to Hong Kong and conducted audit reviews on two of the auditors. Those auditors are U.S.-based auditors, the big four U.S. accounting firms. And in December of 2022, they said that those two auditors passed the review. They then subsequently went back to Hong Kong, and yet they've not opined on the remaining auditors, which means that we think this delisting risk is greatly, greatly diminished, that these are U.S. auditing firms. The PCAOB has actually fined several of the auditors for deficiencies they found, and yet they've not opined. And we believe that's due to some of the political blowback they received from members of Congress for just simply doing their job. And it's an unfortunate situation that I think they feel some sort of political pressure, despite the PCAOB being part of the U.S. Treasury, which falls under President Biden's purview, trying to stabilize the relationship. This is an opportunity that the U.S., due to the risk it gives to U.S. investors, they should resolve, and yet they've not. It's unfortunate. I think it's the political situation. So unfortunate that we think it's greatly diminished. Theory is still out there.
Brendan, I know you provided the CBBC's daily turnover in Hong Kong. I think Michael, I could pronounce your name wrong. I apologize for that. Is asking for how much of the snowball liquidation is still left. I guess the market wouldn't know the exact size, but the daily turnover has shown a significant number, at least for the callable, and then the bear contract was somewhere around $9.7 billion, if I recall your notes yesterday correctly.
Yeah. The snowball is the mainland China. The thing to be aware on the mainland China is that what we don't have as much clarity is exactly where are these knockout prices. But I think it's very clear that an element of this intervention is to prevent the mainland market from potentially breaching some of those levels. So in the case of Hong Kong, again, we don't know the aggregate side of the market capitalization. There's not been any sort of intervention to prevent, a downdraft. In November of last year, the South Korean government banned short selling of South Korean equities in order to prevent such a drawdown. So we've not seen a proverbial intervention within Hong Kong thus far. It's hard to say, but I think it's got to be hitting a lot of people's radar, particularly for the Chinese government. I mean, this drawdown in Hong Kong, it feeds a lot of the negative media narrative, and so the Chinese government should care about that issue. They really should, and it's an unfortunate situation that there aren't buyers stepping in, but it's just some of these headwinds that we think have diminished, have prevented people from coming in and being a buyer despite the opportunity we see. And that situation could rectify itself very quickly in terms of some sort of policy adjustments to prevent the Hong Kong equity market's reputation to be further tarnished, for the Chinese economy's reputation to be further tarnished.
These structure products, and then they have the forced redeem.
That's the key. That's the forced redemption aspect that forces the issuer to liquidate the underlying. There's nothing wrong with structured products. It's this particular that's very popular locally is that's the problem. Mm. And I think that's something that, in light of the situation, when you have market stress, here in the U.S. we have circuit breakers. Hong Kong has no circuit breaker. It's so some of this is an unfortunate market structure issue.
I had a question on the macro level, Brendan. We have a lot of good questions. Thank you for everyone who sent in the questions. We have a lot. We can't address all of them. If your question didn't get addressed, get in touch. Brendan and I will be more than happy to have an individual or offline conversation with you. But here got one question on economy, Brendan. In general, do we think the economy is slowing down? And second question by the same person is why China didn't do a bit of a massive stimulus in one go. I'll start a bit, and then please feel free to add in, Brendan, and you watch it very, very closely. Well, a couple of things. I think China is really realizing they need to rebalance its economy to a long-term sustainable economic model. Namely, they cannot forever manufacturing the T-shirts for next decade. They need to rebalance it, themselves to climb up on the value chain. And we say it, we meant it. If you look at the recent export data, I know the exports of the last year was not a beautiful picture, but if you look at the components from the exports parts, you would see the renewable energy product related products is one of the top 3 exports products. Batteries, EVs. So you see they are already changing the key components and items they manufacturing, or they are focusing on manufacturing to exports to. So China is almost at a very interesting point now, is you're out of a 3-year lockdown, first year returning to focus on growing your economy. At the same time, you're rebalancing your economy. You're almost rebalancing your economic model to where and how to focus to grow your economy to be long-term sustainable in the next decade to come. Have they shown some results? Those 3 components are the top 3 or the new 3 of the exports that China is exporting now. So they have done their very important first steps. Will you see a bit of a single digits GDP growth from here going forward? I'd like to think that might be the case, but then the base is a lot higher. That 5% GDP literally can help them to achieve the 2 goals that Brandon mentioned in one of the pages, is their modernization goal and their urbanization goal. If they could maintain a 5% year-over-year for the next decade, they could have the room and budget to achieve that return long term. And then the other things I want to mention on massive stimulus is at the very beginning, they did worried about recreating the shadow banking that they have done or falsely done during 2008, and all the way took them probably to 2015 to seriously completed the deleveraging. That lesson is learned in the hard way, so you didn't see helicopter money in this round. But they have done multiple rounds. One of them, my page of showing 2023's stimulus package from March to December, you would realize it's a lot of liquidity being provided into the systems, very targeted. That means they cut the risk on the long end, 5 to 7 years. That's for corporate. The middle part for mortgage, the short end is to make sure liquidity is sufficient. So every single interest rate cuts or rates cuts was targeted to make sure liquidity is provided into certain sectors, industry, or lenders they could potentially impact. That's one. And they did provided quite a bit of sizable injection, a couple of trillions, but in different purpose. The first one was to say infrastructure, green infrastructure, disasters, infrastructure builds, so on and so forth. That's really tough for, fixed assets investments, if you think about it. And then $1 more trillion was introduced to target on real estate developers. You can come forward, borrow the fundings from them to kick off projects, and the very recent of the $1 trillion announcements. Brendan, do you have anything to add on that front?
No, I couldn't agree more. I mean, it was BYD just launched a cargo ship full of EVs for Europe, and to your point, it just shows some of the new drivers of China's economy in terms of the clean technology, where they've invested very wisely, solar, wind, battery, electric vehicle, hybrid. Um, Electric vehicles have been such a controversial thing here in the U.S., where hybrid just makes so much sense. And yeah, I had the opportunity to ride in a BYD minivan, and while I visited their factory and headquarters in Shenzhen, and yeah, just remarkable product. They've done really well. Yeah, it's an area they've really innovated.
Right. I think we have overrun by 70 minutes now. Dan asked how can he get access to the deck. Dan, do get in touch with us at info@KraneShares.com. Be very happy to share with you on the deck. Bernie, any other questions caught your attention?
Well, the one about Badu, I thought is that there's a headline out of Asia about the Chinese military using Badu's chatbot, which led to a dramatic fall in Badu's Hong Kong share class. And it's something that, to the company's credit, they vehemently denied. They publicly filed their denial in Hong Kong with the stock exchange. The initial article was subsequently corrected, was edited, and yet investors lost $4.6 billion in market cap. And what's the consequence to the media organization and the journalists who wrote that article?
Mm-hmm.
It's the Badu has said, we're using our chat bot, Ernie bot, for commercial purposes, nothing to do with the Chinese military. We've seen a researcher went and actually read the piece, the academic piece that was cited as the source for the article, and said it's nowhere in there. It's patently false, and yet there is no consequence. And it's I think in general, as investors, we recognize that we want to be invested in the growth parts of China's economy, and the consumption trends, the battery makers, the EV hybrid providers, the healthcare companies, and it just shows it's an unfortunate consequence of the sediment. But at the same time, I'm quite optimistic. We're seeing so many of these. The U.S. Janet Yellen's team from the U.S. Treasury is in Beijing as we speak, meeting with their counterparts, and yet I challenge you to find a Western media source that spoke about it. To their credit, the Financial Times is the only one. So yeah, we're just fed this negative narrative, and I think it just proves the lack of accountability, the lack of credibility a lot of these media sources have, which is why we produced China Last Night on a daily basis, and why we provide research like the Outlook piece up on KraneShares.com. I'm being told, Xiaolin, that we have to wrap it up here, but I just want to just a quick shout out. Xiaolin's been under the weather. You did a great job, and just get back into your pajamas, get back into bed, get back to 100%. But just a hero's job today, Xiaolin, battling through some a little bit of underweather on behalf of all of our shareholders. Just want to make sure people know you're suffering, and yet you don't show it.
Right. Thank you, Brendan. Thank you for everyone for your time and attention today. I know we addressed probably about 10 or 12 questions. We still have a few more remaining for the time we don't have. Get in touch. Brendan and I would be delighted to go over all of your questions. Okay, don't feel left out. Get in touch. If you need anything, you know our information, how to get in touch with us. Thank you for your time. Thank you for your attention today.